Hello, this is Julius from Basic Financials. Today I'm going to do a video to recap on the tax relief that's available for interest on loans to buy residential property that you're letting out. I've been getting lots of questions saying, oh, it is right that you don't get any tax relief now on interest on loans, isn't it? And the answer is no, that's not right. You'd be forgiven for thinking that because it does look like that when you're looking at HMRC's information if you don't look more carefully. Basically, there have been changes over the last 4 years which have been phased in, and now this is the first year, so the year ended 5th of April 21 is the first year where it's fully taken into effect. So if I say how it is now, and then I'll just recap how that changes to what it was before, so that to try and explain where the confusions come. So what happens now is, yes, it's right, you can't set off the loan interest against your residential rental profit, residential rental income in arriving at the profit. Your profit on the rental income will be your residential rental income minus the costs related to that income, but not including the loan interest. And then you arrive at your profit, and you pay tax on that profit at whatever rate your tax is. But you do get relief for the interest on loans for residential properties, for renting out when you're renting them out. The way you get it now is because you used to get relief at 40% and they've restricted it now to 20% relief. And the way they do that is by giving you a tax credit of 20% of the interest. So if the interest on your loan is £1,000 for the year, you'll get £200 tax relief against the tax bill relating to your rental profits. So I might just recap on that just so that you can sort of sink in how that works. So to work out your rental profit, you take your rental income, then you take off your rental repairs, your agent fees, things like that, to arrive at your rental profit. Forget about loan interest at this point. So you've got your rental profit. That gets added to your income and you pay tax on your income. And that might be at 20%, could be at 40%, could be at 45% if you're an additional rate taxpayer. But importantly, you're paying tax on the profits at your marginal rate. But if you've got a £1,000, if you pay £1,000 interest on the loan for that rental property, you will get a tax credit of £200 against your tax bill. I hope that's clear. Now, the way if you make a loss on that profit, on that rental income, on that rental property, you wouldn't get the tax credit. You only get the tax credit on that loan interest against the tax bill for that property. So if you obviously made a loss, you wouldn't have a tax bill for that property. But you still want to be putting the information in because the tax credit will be carried forward to future years. So you'll still get relief for it if you make a profit in the future on the property. Now, the way it shows on your tax return now, when you're filling out your tax return, you'll put in your rental income and you'll put in your expenses in the boxes that it shows. And after you've done that, there's then finance costs on residential property, and that's the bit where you put your loan interest in. And there might not just be loan interest; it could be if you've taken out a new loan, you might have had a loan fee that would go in there as well. If you've remortgaged, for example. So it's a bit after you've found out what the profit is on your rental profit. There's another box which says about finance costs, and that's where you put your loan interest in, and that's how the calculation will work out the 20% tax relief. Now, the way it used to happen is you would just put in your loan interest as an expense, and therefore it would come, the interest would come off your profit, and therefore if you were a higher rate taxpayer, you would effectively be getting 40% or 45% tax relief on your loan interest. But the changes they made were to so that you wouldn't get the 40% relief, you'd only get 20% relief, and they phased that in over 4 years. So if you've not been putting loan interest in for the last 4 years, you want to be going back and having a look at your tax return. What you would have done for the first year they phased in, so 4 years ago, they were giving, you would put 3/4 of the interest as an expense against the profit and 1/4 as a finance cost. Then it was half, and then it was 1/4 as an expense and 3/4 as a finance cost. And as I say, for the year in the 5th of April 21, this is the first year that it's fully in place, so you get nothing as an expense but the whole lot as a finance cost, and then 20% relief on that. Right, that sounds a bit complicated to me in my head, but hopefully if you listen through the video a few times and do a bit of research, and with this video and the research, hopefully it will all fall into place, and when you see it on the tax return, when you're filling it in, which should make sense. Thanks for listening. If you've got any questions or comments, please leave them in the box below. And if you could like and subscribe as usual, and you'll find out when I put new videos up. And yeah, thanks for listening again, and I'll see you again for another video soon. Bye.